When will the Federal Reserve Bank start cutting interest rates? Well, if you ask Wall Street, they'll tell you that the Federal Reserve Bank is going to start cutting interest rates in 2024. UBS, Morgan Stanley, and Goldman Sachs put out statements this week talking about why the Federal Reserve Bank will start cutting interest rates in 2024. UBS and Morgan Stanley both agree that the Federal Reserve Bank will start cutting interest rates earlier in 2024 and that we will see deep interest rate cuts in 2024. Goldman Sachs says that we will start seeing interest rate cuts towards the end of 2024 and that they'll be a little bit more gradual. So what I want to do in this video is talk about why and what Wall Street is saying regarding the Federal Reserve Bank and future interest rate cuts. Then I want to talk about what's going on with inflation because we just got the latest inflation report as well. And then I want to wrap this video up by talking about Moody's and why they're concerned about the United States debt. Moody's is one of the big three credit rating agencies. They put out a new warning about the United States debt. And finally, I'm going to talk about why this matters for you. So let's start by talking about Wall Street. And more specifically, I want to talk about why you have some banks like UBS saying that we're going to see deep interest rate cuts in 2024. UBS says that the Federal Reserve Bank is going to cut interest rates to 2.5% to 2.75% in 2024. Now, to put that in perspective, we are just over 5% in interest rates. This interest rate is set by the Federal Reserve Bank. The current interest rate is just over 5%. So UBS is expecting and predicting that the Fed will cut interest rates in half in 2024. Why? Well, they said two things. Number one is going to be cooling inflation, which we've been seeing inflation cool down according to the latest data reports. And number two is because they're expecting a deep economic slowdown as well into 2024. So UBS and Morgan Stanley are kind of agreeing that because we're going to see this economic slowdown, the Federal Reserve Bank is going to be forced or enticed to want to stimulate the economy. And how are they going to stimulate the economy? By cutting interest rates to make borrowing money more accessible. Goldman Sachs is a little bit different here. Goldman Sachs says that the Federal Reserve Bank is going to start cutting interest rates towards the end of 2024. UBS, Morgan Stanley says that we are going to start seeing these interest rate cuts in March-ish of 2024. Goldman Sachs says, well, we don't think we're going to see interest rate cuts until the end of 2024 because of the lagged effect of the slowing economy, because of the lagged effect of the cooling inflation. But when the Fed starts cutting interest rates, it's going to be a little bit more gradual, and that it's going to be a smaller interest rate cut in 2024, and then it's going to continue on in 2025 and 2026 because of the slowing economy. Now, all these banks are kind of saying the same thing, that inflation is cooling down, and that's what's going to give the Federal Reserve Bank fuel now to start stimulating and boosting the economy through the interest rate cuts. Now, of course, people have reasons for wanting interest rates to be cut, and people have reasons for wanting interest rates to go higher. People who want to go out and buy things, people who want to go out and see investment values rise, they prefer interest rates to be cut because when you have lower interest rates, you have more money entering the economy, you have more debt entering the economy, more spending happening, and that also boosts investment values. So there's a reason why you have a lot of institutions and people who want to see interest rates get cut. On the other hand, if you are in the market to purchase and you have cash, well, then you want higher interest rates because investment values generally go down when you have interest rates go up, because when interest rates go up, people need higher returns to justify buying an asset, which means you generally have more negotiating power if you have more cash. So you got to understand people's incentives when it comes to interest rates. And the reason why the Federal Reserve Bank has been working to raise interest rates is to combat inflation, which is why now I want to talk about what's going on with inflation because we just got the latest inflation reports. And what it said is that CPI, the headline inflation, came in at 3.2% for the last year. That is exactly where we were 1 month ago. So this is where now you have a lot of people saying, oh, inflation now is not going up. It's kind of just steadying out here. That's good news because, well, people are saying that it's not going higher anymore. And then the bigger news that people were excited about was core inflation. This is what the Federal Reserve Bank likes to look at. Core inflation came in at 4% as opposed to the 4.1% that we had last month. That's about double where the Federal Reserve Bank wants to be, but it's a little bit lower than where we were before. This is why you have a lot of people getting excited because now they're seeing CPI kind of come down and stay down, and then you have core inflation going down slightly. Now remember, the Federal Reserve Bank wants to see 2% inflation. Core inflation is at 4%. That's double what the Federal Reserve Bank wants. But a lot of people are saying that this is going in the right direction, so the higher interest rates are working. This is why you have a lot of banks and institutions saying that this is going to give the Federal Reserve Bank ammunition to start cutting interest rates, especially if we see a slowing economy. Not to mention the fact that we have some concerns about the United States government and their ability to pay back their debt. Now, before I go into what Moody's said, I want to remind you that if you are an investor, you want to be an investor, and you want to learn how you can learn how to save your money, learn how to invest your money, learn how to put your money to work, learn how to grow your assets, my team at Briefs Media put together a free ebook titled How to Build Wealth as an Investor. And if you want to read this ebook, you can do it for free. All you gotta do is click the link down in the description below to download the ebook, or you can go to briefs.co/ebook to get a copy of this ebook for yourself for free, that we can start learning about that financial education and how to use your money smartly. Now, let me start by talking about Moody's here, because this one is kind of important, but it was really just swept under the rug. Moody's is one of the big three credit rating agencies. If you remember, earlier this year, we had another credit rating agency come out and downgrade the United States from AAA down to AA+. A AAA rating by a credit rating agency essentially means that this is a risk-free investment. So if the United States goes from AAA down to AA+, it still means that the United States is essentially risk-free, but just not as risk-free as it was before. And the reason why this matters is because you have a lot of institutional investors, you have a lot of governments, countries around the world that lend money to the United States. So if the United States debt or credit gets downgraded, that generally means that the United States is going to have to incentivize investors with higher interest rates to keep lending money to the United States. Why does that matter for you? Because how does the United States pay back their debts? How does the United States pay for anything? They pay for anything with tax dollars through taxpayers. So now, if the United States government is having to pay higher interest rates on their treasuries, a treasury is a loan that anybody makes to the government. If the United States has to pay higher interest rates on their treasuries, that means more tax dollars are going to be used to pay back interest. That's why this most recent statement by Moody's is so important, because they essentially gave a little warning to the United States that you, the United States government, has a lot of debt. We, Moody's, a credit rating agencies, are getting more concerned about your ability to service and pay back all of this debt. That's why we are giving you a little warning. Before we downgrade you, we're not downgrading you right now, but we're letting you know that we're getting concerned about your debt. And if you don't handle this, we might be forced to downgrade you. So they gave this kind of warning, this little slap on the wrist to the United States saying, hey, you have all this debt, all this national debt. On top of that, your interest rates are rising. Now, why are interest rates rising? Because for one, the Federal Reserve Bank has been working to increase interest rates. That means the United States government has to pay out higher interest rates on all their debt payments. That's good for you if you own treasuries or if you're buying treasuries. But it's not so good for the United States government, because that means now all their debts are becoming more expensive. That means they have to pay more tax dollars to service all these debts. And the second reason why this is important is because now if people are concerned about the United States debt, they're going to be less likely to lend money to the United States. And if they're less likely to lend money to the United States because they're worried about risk, the government has to pay you higher interest rates, right? Risk and reward. The higher the risk, the higher the reward has to be. So if lending money to the United States becomes a little bit riskier, and by riskier, I mean a little bit riskier, that means higher interest rates. Again, that means more payments out of the United States bank accounts to investors in order to justify people lending money to the United States. And the issue is the United States has to keep borrowing more and more money. In the fourth quarter of 2024, the United States borrowed a record amount of money. Why? Because we continue to keep spending. This is the issue that Moody is highlighting. The United States keeps spending money, they keep racking up their debts, and they're worried about their ability to keep paying back the debt. Let me read you a quote from Moody's here. What they said is that they're downgrading the company's economic outlook to negative from stable because of fiscal deficits. Quote, with higher interest rates and without effective fiscal policy measures to reduce government spending or increase revenues, deficits would remain large and weaken the country's debt affordability. Now, naturally, when the statement was put out, people were concerned. And this is where the White House put out their own statement responding to Moody's. Let me read you what the White House said. Quote, the American economy remains strong, and Treasury securities are the world's preeminent safe and liquid asset. AKA, you got nothing to worry about. Lending money to the United States government is the safest thing that you can do. It is risk-free, and it has been the safest thing that you can do. And you're absolutely right. For the last century, lending money to the government has been a risk-free investment. However, the question that investors have, can it stay like that forever? And of course, only time will tell. But the worries now are that the United States government is spending money faster and faster. They're going to have to spend more and more money to pay back these debts. In fact, the fastest growing expense on the United States financial statements is interest expenses. It's not defense and military. It's not infrastructure. It's not giving money back to the citizens. The fastest growing expense is paying back their debts. Now, we all know that if you are constantly spending more money than what you generate as a household, that's going to lead to financial problems, especially if you're not seeing your incomes grow as fast. Well, you have some people saying that those rules don't apply to the government. And this is where I want to remind you that, well, only time will tell. What we've seen happen for centuries now is that civilization after civilization, if you continue to spend money faster than you can generate it, that can create issues. So something for you to be aware of, and really understanding that this is not something that happens overnight, these types of changes, but this is something that you want to be aware of, understanding that there are these concerns about the United States debt, understand that there are these concerns about the United States spending more and more money on interest payments, understanding that there are concerns about about our economy, understanding that there are concerns still about inflation. Inflation is still high, understanding that there are concerns about the impacts of higher interest rates. So what does this mean for you? Well, we're getting close to the end of 2023. And if you remember what I've been saying, 2023 is not the year for you to go out and finance a new truck. Why? Because I want this to be the time that you are working to build your financial education. I want this to be the time that you're working to build your financial preparedness. That means learning how to invest your money, learning how to capitalize on opportunities. Because the reality is, every phase in the economy creates economic opportunities for those who are financially educated. If you're not financially educated, then you're the one that's paying the price. And secondly, in order for you to capitalize on these opportunities, you have to be financially prepared. That means you have to have some cash put aside to be able to protect you and also capitalize on opportunities. Because you can have all the financial education in the world, but if you don't have any money to be able to take advantage of opportunities, well, then those opportunities just kind of drive by. And that's why I want you to use this time to be financially smart, use your money smartly, and start building that financial education. And with that, I'll see you in the next one.